Hey, what's up, everybody? Welcome back to Investing Sucks, and today we're going to be doing a more philosophical type of video. A video that is going to be an intellectual exploration into one of the more controversial topics on investing, which is should you overpay for growth? Or, in other words, when does it make sense to invest in a company at a higher valuation because you believe that that company has higher future growth potential? Now, this is a debate that usually goes something along the lines of one person suggesting that paying high prices for companies, even if they have this perceived growth potential, is a losing strategy because if they don't end up living up to that potential, then you're probably going to end up losing money in the long run. And then the counterpoint to that would be if you want to invest in a fast growing, high quality business, then you have to be okay with investing at higher prices. And companies like Amazon, Google, Tesla have all turned out to be great investments, and they were never really trading at what you might consider cheap valuations. And this is a question that came to my mind over the past 2 weeks because of what we saw happen with Nvidia stock. And they released their quarterly results, and it was essentially a blowout quarter for them, right? The guidance that they released was extremely positive as well. And they basically said that their business is going to nearly double in size by next quarter and probably continue growing very fast well after that. And really, they've become the industry standard for computing technology to power this new wave of AI that's starting to become ubiquitous. Now, me personally, I haven't gone into the weeds on this company really, but I do remember looking at them sometime last year and just thinking to myself, it's too expensive, right? There's just too much optimism priced into this company right now. And that doesn't necessarily mean I think it's a bad investment, but it's a risky one, right? Because if they don't meet those lofty expectations, you are faced with a lot of downside risk, which could become permanent downside risk if they can never actually change things in their business and get back to those expectations that people once had for them. And really, for every example out there you can point to of a company that seemed perennially expensive but still delivered great returns for many years, there's plenty of other examples out there of other companies that looked equally as promising at the time, and it didn't go so well for them, right? They didn't deliver those great returns. They ended up actually being overvalued, and now we don't even hear about those companies. But for the case of Nvidia, they're up 150% year to date. So when you see this, you start to think, okay, maybe this overpaying for growth thing isn't actually such a bad idea. So this got me thinking, okay, what does the data on this actually say? Let's remove all the opinions and all the emotion. What does the data say about overpaying for growth potential? And how often is it that when a company has these astronomical, very optimistic assumptions built into their stock price, how often is it the case that they actually live up to those expectations and still deliver great returns versus it's revealed that they were actually overvalued? And then a similar test would be looking at it the other way. So, how often is it that a company that actually ended up growing very fast and being successful was correctly priced as such, priced as this high growth company by investors? So, how good are investors at foreseeing future growth potential in stocks, basically? So what I'm going to do in this video is a few different back tests, and again, just see what the data says. And I think this is a very important test to do because as an investor, it's good to have the data and the facts behind a given investing strategy that you choose so that you can be informed on what works and what does not work from a historical basis. And you also have to think about it, right? In the game of investing, you want to avoid being wrong as much as you can. And you can only really afford to be wrong or have misguided opinions on the way things work for so long before it eventually comes to bite you. And it's possible that you could have this misinformed opinion, but it just doesn't really get revealed. Maybe luck is on your side and you're still having great results in investing, but eventually, over the long term, something bad is probably going to happen to you if your opinion is actually misguided. So, because of this, I just wanted to see what the data says on this. So, without further ado, let's actually dive in. So to do these back tests, I'm going to use my website here, which is called tickernomics.com. This is currently a free website, and I'll leave a link in the description of this video if any of you guys want to check it out. I created this website really to just help retail investors get better at analyzing companies and expand their knowledge base. And one of the key features of Tickernomics is what I've called scripting. And this basically allows you to do these very complex calculations using millions of data points from financial statement data, stock price data, economic data. And one of the things that we can use scripting for is to do back tests of certain investing strategies. And doing these back tests, it does require coding knowledge. So for example, this is the code that I wrote for one of the back tests that we're going to do, but we are currently working on a feature called back testing, which allows you to do certain back tests without this coding knowledge, right? So stay tuned for that. And if you are interested in learning more about Tickernomics and keeping up to date with what we're working on, then I'd recommend following our subreddit here. It's just r/Tickernomics. So all of these scripts that I created that I'm going to show you throughout this video that actually do these back tests for us, you can access as well if you just go to, again, tickernomics.com. And if you click on public scripts here, you can access all of these completely free of charge. So if you are interested in examining the results for yourself, then you can go ahead and do that. And then also we have plenty of other scripts that all do unique things on the website that you can check out as well. We're really trying to build this library of scripts that all do something unique, whether it's generate a list of companies that meet certain conditions, again, perform some complex calculation, etc. So if you are interested, I'd recommend exploring our public scripts here. But I'll show you the scripts that I have created that actually do these back tests for us. So one of them is going to be high-priced companies back test, and we can see here there is an 8-year one, a 3-year one, and a 5-year one. So I wanted to use different time intervals just so it's independent of whatever specific time I use, because as we know, like depending on which time period you start a back test, like if you were to start a back test, right after the 2008 financial crisis, the results are going to appear very strong just because we've been in a bull market since then. So I tried to make it independent of the time period. But what this backtest aims to do is, again, we're trying to identify high-priced companies and then actually trying to determine, did those companies live up to their higher valuations? And obviously, this is going to be a little subjective because we do have to specifically define what a high-priced company is. And I have used the price to sales ratio as the main barometer for this. And I could have also used the price to earnings ratio, but I used the price to sales ratio just because it's more consistent over time and it's more comparable between companies. If you look at something like the price to earnings ratio, this can fluctuate a lot just depending on one-off items that are impacting earnings or various accounting adjustments like unrealized gains and losses. So things like that can kind of skew a PE ratio. The price to sales ratio doesn't really have that, so I decided to use that as the main metric for determining if a company is expensive or not. Now, the one other thing we have to consider is how do we account for different industries? Because different industries are going to have different price to sales ratios that are considered normal. Like if you think, for example, a grocery store versus a tech company. A tech company is going to have a much higher price to sales ratio than a grocery store. But if we're looking at, for example, a grocery store that is considered high priced, you would have to look at their price to sales ratio relative to the industry average. So that's what we're doing here to define high priced companies. It's a company that has a price to sales ratio that is at least 2 times as high as the industry average. So that's the criteria that it needs to make this list. And then we're basically looking at what type of returns you would have achieved on those companies if you were looking at them, or basically if you had bought them 8 years ago and held them to now, or 5 years ago, or 3 years ago, depending on which one we're doing. And then I also included just other conditions just to kind of clean up the data. So I excluded biotech companies just because biotech companies are really this unique part of the market that kind of plays by its own rules. I also excluded financial services companies because the metrics that you would use to analyze non-financial services companies aren't really the same ones you would use to analyze financial services businesses. For those ones, you use things like price to book ratio, net interest margin, loan loss reserves. So they're a little bit different, so I just excluded them. I also excluded SPACs because those aren't really companies to begin with. And then also any company that had a market cap below 100 billion, just to exclude some of these, smaller companies that, are a little bit more less liquid. You can't really assume that you would have invested in those companies at whatever the stock price is saying because it would have been, they're less liquid. If you were to try invest in them, it might have manipulated the price a little bit. But that's the main criteria that we have here. So I'll show you what this looks like now. And then I also want to point out that we did create another script that looks at companies that that meet this list as of now, so the currently high-priced companies. For example, if I look at this script here, which is called PS ratio 2 times industry average. So if you want to run this, you can just search it in public scripts, and then you'll click Save to My Scripts here, and then it takes you here, and then you just click Run. And that's going to take a few seconds because what it's doing is it's iterating through every single company that we have on the website, which is over 10,000, and determining if it meets this criteria. And now we can see here it's done generating the list. So go to Insight Tables, and then we can select it. So we go to Insight Tables, and here's our list. So this is what this list looks like right now. These are what you would consider the high-priced companies. So the companies with a price to sales ratio that is 2 times the industry average. But the actual scripts that we're going to use for the back test, because that's what we're interested in, is the back test. So we'll go back to public scripts here. And we can look at, say, the high-priced companies. So this is the 8-year back test. Hit Save to My Scripts, and we'll run this. So now it's done generating the list, and we can go to Insight Tables, and here's our list of companies from the 8-year backtest. And this does include delisted companies, in case you were wondering that. So personally, I think this is very cool, and this is really why we created this scripting, was because it allows you to really use your creativity, and you can look at things that perhaps no one else is looking at and really find some unique insights. But what I've done is I've actually already ran these scripts, and I've exported them into an Excel file here and kind of summarized the results of what this backtest actually yielded us. So let's dive into that next. Okay, so now it's time to dive into the Excel summary that I have here, which show our results. So we'll start with the backtest that was the high-priced companies 8-year backtest. So again, this is companies with a price to sales ratio that was 2 times the average for their industry. So companies that met that condition, their average return over 8 years, so this is an 8-year annualized return, so return every year, was negative 12%. So negative 12% every single year for 8 years for these companies. So that is obviously not very good. Now you may be thinking, well, that's the average. That could be just being dominated by a few, very bad companies. That doesn't really capture what we're trying to measure here. So I looked at the median return, so the return that's kind of in the middle of the distribution, and it was negative 5.66%. So on majority of these companies that meet that condition, that are these high-priced companies, you're losing money. You're not even underperforming the market. You're just losing money. And the number of companies that actually increased in value over those 8 years was 42% versus the number of companies that lost money was 58%. And maybe you're looking at that, you're thinking, well, that's not so bad. I mean, 42% of companies increased in value. Remember, what the whole point of doing this, investing in individual companies is to try and outperform the market, right? To achieve high risk adjusted returns. And what this data says is that the risk that you're assuming when you invest in these high priced companies, you're not really going to be adequately compensated with a high return. So then another question that I had was, did the results get worse the more expensive companies got? So the answer to this was a resounding yes. So let's assume that we're only looking at companies from this list with a price to sales ratio that was 5 times the average for their industry. For those companies, their average returns were negative 25.37%. So that means every year for 8 years, you're losing a quarter of the value of your investment. That is obviously quite terrible. And then only 18 out of the 76 companies that actually met that condition, so 5 times the industry average, actually had positive returns. And again, that's not even assuming they outperformed the market. That's just they didn't lose money. Now, that being said, there are still exceptions. And here are a few companies that made the list with some data on them. And this column here is what their annualized return was. So Lululemon, for example, their price to sales ratio as of 8 years ago was 4.1 versus the industry average, which was 1.1 for their industry, which their industry is the apparel retail industry. And for 8 years, their annualized total return, so this includes dividends and dividend reinvesting. And by the way, we are including delisted companies in here, was 23%, which that's a really good return. And then this company, Old Dominion Freight, which is a trucking company, 27.8% return. Copart, 22. Waste Connections, just about 21%. O'Reilly Automotive 19%, and then Dollarama actually had about 18% annual return. So there are companies that are exceptions to this rule. And this right here, what we're looking at is a distribution of the returns. So each dot in this list represents a different company. And what we're looking at on this axis here is the actual total annual returns over those 8 years. So we can see, these are the companies that had positive returns, and then there's much more companies that had negative returns, and even some very negative returns. We're talking almost negative 80%, and that's every year for 8 years. So that means your investment is going to be worth pennies at that point. But that's just 8 years, right? Maybe 8 years was just a bad sample. Let's look at 5 years. Really, it's the same story. So the average annualized return for 5 years, negative 16%, and then the median return, negative 5%. But it's slightly better than what we saw here. Well, the median return is slightly better, it looks like. The average return is much worse. Um, Now, the number of companies that actually increased in value is pretty similar, around 40% versus 60% of the companies lost value. And then I also wanted to answer the question, did things get worse the more expensive the companies got? The answer to that was, again, yes, as those companies with a price to sales ratio that was 5 times the industry average had negative 28.7% annual returns over the 5 years. And then only 16 out of the 73 companies that met that criteria actually had any sort of positive return. And then once again, there are exceptions. NVIDIA was actually an exception to this. Their price to sales ratio, this should be 5 years ago, it says 8 years ago, but their price to sales ratio as of 5 years ago, 13.6 versus the average for their industry, which they're in the semiconductors industry, was about 3.6. But despite that, they had 40% annualized return over the 5 years. And then another one was this royalty trust, this oil and gas company, which also had very strong returns over 5 years. So there are exceptions, right? But if you're looking at it in terms of, are the odds on my side basis, the answer to that appears to be no. And then again, this is the return distribution for the 5-year backtest, pretty much the exact same pattern, right? Now, let's look at the 3 years, see how things have changed. And the results seem to be a little bit better. The average 3-year annualized return for, again, the exact same companies where their price to sales ratio was 2 times as high as the industry average, was negative 8%. And then the median return was negative 1%. So the fact that things are getting better, the shorter the time periods are, to me, it kind of makes it seem like maybe it just takes some time for these things to reveal, right? And the longer you're holding on to a company that you invested in at high valuation, the worse things are going to get, historically speaking. And then 48% of companies actually increased in value, which was a greater percentage than what we saw in the 5 and 8 year backtests. So again, things are getting better the shorter the time periods are. And then the percentage of companies that lost value was 52. And then once again, I looked at this question, did the results get worse the more expensive companies got? Again, the answer was still a yes, with the companies with 5 times the industry average, their average returns were just under 20%, just under negative 20%, that is. And then 28 out of the 95 companies had positive returns. And again, that's just positive returns, not companies that outperformed. But, there's still exceptions. NVIDIA obviously is a huge exception to that. Their price to sales ratio, they should say 3 years ago, was just 13, and then the average for their industry was just over 4. But over 3 years, their annualized return was 62%, which is obviously extremely high. And then this is what the data looks like for this. So we can see there were some companies that had very, strong returns. And there are exceptions to this rule, but if you're looking at it on a balance of probabilities, a lot of these companies are actually losing value. So last thing I want to look at is the high growth companies backtest. So now we're looking at things from a different lens. We're saying, okay, let's take companies that grew very fast. So let's throw away their valuations. Let's just look at companies that had very high rates of revenue growth. And the way I define that is 30% revenue growth compounded each year for 5 years. So I think most people would assume that that's pretty high. Were they priced as high growth companies by investors prior to that, right? And again, the way I'm looking at that is I'm basically comparing what the company's price to sales ratio was versus the average price to sales ratio for their industry. So the percentage of companies that achieved these high growth rates that had their price to sales ratio greater than the average for their industry was 25%. So only one in every four companies that actually ended up being high growth companies were given a price to sales ratio above the average for their industry. So not even two times the average for their industry, just what was above the average. And then the percentage of companies with a price to sales ratio that was below the average for their industry was 75%. So what that tells us is many investors are really failing to recognize future growth potential in companies because these companies that are growing, very fast for 5 years were not priced as such prior to those growth rates being realized. And then what I was also curious to determine was how did the returns, so again, the annualized returns over that 5 year period for these companies, how did it, differ versus if the company had their price to sales ratio above, so it was an expensive company versus if it was a cheap company. So if it was an expensive company, the average return was just under 3%, versus if it was a cheap company, it was 14.3%, which is this is actually outperforming the S&P 500 over that time. So that's what the data says, and from that I have drawn three main conclusions here that I think are key lessons we can learn from this that I would like to conclude the video with. So number one is investing in companies at high multiples. It doesn't guarantee failure, but it's a risky game, and on a balance of probabilities, it's probably going to lead to losses in the long run, and those losses seem to get more extreme the longer you hold on to those companies. And then number two, companies with high valuations are not necessarily the ones that will achieve the highest rates of revenue growth. Because as we saw from here, there's lots of companies that had very strong rates of revenue growth that were not priced, as aggressively. And then number three is you don't need to invest in companies at high valuations to achieve good returns. So that counterpoint that you often hear, where you have to invest, if you want to invest in a high quality business like Tesla or Apple or Amazon, these companies are never going to trade at cheap valuations. So if you want to get in, you have to be willing to pay high prices for these companies. That doesn't really seem to be true. Although it can be true in some cases, it's not a necessity that you have to invest in companies at high valuations to achieve good returns. There's plenty of other opportunities out there in smaller, less followed companies that are not trading at excessively high valuations that you can achieve equally as good returns on. You just need to, put in the work and find those companies. But anyways, guys, that pretty much does it for this video. So I hope you did find this insightful. If you did, then please leave a like. And if you're new to my channel, I'd appreciate it if you would consider subscribing. And I'll see you guys in the next video.